What's up, everybody? Happy Wednesday. Got a quick $10K to $1 million portfolio update. We'll just share what the portfolio did on the day. And then I want to talk about why I don't own oil stocks and why I'm sticking to tech stocks, even though oil stocks are up 25% year to date and tech stocks are down 25% year to date. And one of the greatest investors of all time, Warren Buffett, has been heavily investing in Occidental Petroleum, which is an oil stock. All right, quick update. It looks like the market was up. The Dow was up 0.2%. S&P 500 was up 0.4%. NASDAQ was up 0.4%. Russell was down. VIX was down. Here's my portfolio, 10K to 1 million, 64,500. We've put in 72,500. We're down about $8,000 total. And then on the day, we were up $812. I'm going to do a full portfolio review on Friday, go through the valuations, my returns, all that stuff. So like the video, subscribe to the channel if you want to see that review. Nothing major in the portfolio. These companies are volatile. They're growth companies. They're tech companies. Gitlab was down the most, but it was also up the most yesterday. So not concerned at all with that. What I want to talk about is why I don't own, and I'm not considering owning oil stocks, even though they're performing so well. As we can see right here, XLE, that's an oil ETF. I'll get into that and we'll talk about the companies in the ETF, how it's performed over time and stuff like that. That's this green line, up 26% year to date. And then the XLK is a technology stock ETF, down 24% year to date. And we could see that XLE was up 67% year to date on June 8th. And now it's only up 26% year to date. And anybody who bought at any time since pretty much April 25th is down on the XLE. Whereas tech stocks are down a lot too, so obviously that's painful. One of the reasons I'm not buying oil stocks is because they're up so much, and I don't want to chase the latest trend in the oil stocks going up, because that's how you get burnt, in my opinion. Same thing that happened with people that chased into tech stocks in the last part of 2021. And so that's number one, is I don't want to constantly switch my strategies. I am a tech-oriented investor. Tech stocks are majorly down right now. In my opinion, that's not the time to switch from investing in tech. The time to switch, if you were gonna switch, is when they get overvalued, too expensive. And that's when, in the future, I might consider switching into something like dividend stocks. Let's zoom out a little bit. 3 years. XLK starts to beat XLE over 3 years. So over the last 3 years, the technology ETF is up 67%. XLE is only up 30%. And that's even after this crazy drop in the XLK this year. And the further we go, the more the XLK, the technology stocks, outperform. 151% versus 35% for the XLE. Over 10 years, 419% return in the XLK versus a 46% return in the XLE. That, my friends, is why I am a technology investor. People might think tech stocks are way overvalued. I don't think so. That's where the growth is, and we'll talk about that right now. $10,000 since it looks like 2012 has now turned into $60,000. If we look at XLE, $10,000 back in 2012 has turned into $14,641. That's the loss, the opportunity cost of owning, oil stocks that whole time, or this oil ETF that whole time. So let's talk about what companies you're going to own if you buy into this ETF, and I'll show you more just from the performance of the fund why I like tech companies better. We see that the average, this just shows the average stocks, right? So they're in general large cap value. They have about an 8 price to earnings ratio, which is considered, value stocks are pretty low. They have a under 1 price to sales ratio, a 3.8 dividend yield. They have 2% sales growth, 17% cash flow growth, and 16% long-term earnings growth. 101%, I believe that's over the last year. That's why that's so high, just the rebound from COVID. But the longer term, 16% earnings growth, 2% sales growth. So let's look at those same metrics for the XLK. And you can already see mostly large cap growth. You can see the price to earnings ratio is 19. The energy stocks were around 8. Price to sales is 4.6. Energy stocks were under 1. Dividend yield is less. It's only 1% versus 3.8%. But let's start to look at the long-term earnings and long-term sales growth. So 13% for long-term earnings growth, 24% for historical earnings growth, and then 14% for sales growth. That's where over the long term, their sales are going to grow so much more than energy stocks at just 2% that earnings growth is going to catch up to the earnings growth of oil stocks. And so let's look at the actual companies that you become part owner of if you buy into the XLK, the tech ETF. So in terms of metrics and ratings by Morningstar, you have a 54% of them have what's considered a wide moat and 40% have a narrow moat. The cash return percent is about 26%, and return on invested capital is 33%. And so if you look, the largest positions are Apple, Microsoft, Nvidia, Visa, MasterCard, Broadcom, Accenture, Cisco, Adobe, and Salesforce. Those are the largest positions in the portfolio, and it's actually pretty heavily weighted towards Apple at 23% and Microsoft at 23%. And then the rest, there's not even another 5% position. That's kind of crazy. Let's jump over to the XLE. Wide moat coverage. So here we go. Already the XLE, there's 0% with wide moats. That's because it's a very competitive industry. Narrow moat, 84. No moat, 15%. Return on invested capital, 12%. Cash return, 14%. And then I forgot to look at these in the XLK, but we'll jump back over. So financial health and profitability are big reasons. So the XLE gets a B minus for financial health. Profitability, they get a D. In growth, they get a C. So B minus, D, and C. For the XLK, we get a B plus, a B plus, and a B. So financial health, they're healthier companies. They're more profitable companies, and they're growing faster. All right, over to the companies in the portfolio. So you get to be an owner of ExxonMobil, of Chevron, of Conoco, of EOG, Occidental Petroleum, Pioneer Natural Resources, Schlumberger, Marathon, Valero, and Phillips 66. There you go. I'm a tech investor. I don't jump trends from one to the other. Oil stocks are hot right now. Tech stocks are not. Just rhymed. Oil's hot, tech stocks not. But I think over the long term, we see the performance of oil stocks has been far better. I think the quality of companies is far better. And I think that they are going to be more recession resistant over time, less capital intensive over time, and less competitive over time than a lot of the stocks in the oil industry. And so oil stocks are cyclical, meaning they go up and down, and they're greatly impacted by the economic cycle and recessions. Whereas tech stocks generally are not as cyclical or impacted by differences in the economy from year to year. I have an email newsletter, austin.substack.com. It'll be linked down below. My latest essay was on MongoDB, a stock that I own in the portfolio. Give me all your workloads. It's free. You can check out the link and check out the email. Thanks for watching.